Welcome to this video on deferred tax, pulling it all together. Now we're going to revise the key principles in IAS 12 for deferred tax. It's important to understand why it is that we have deferred tax. Deferred tax is just a mechanism that we use to adjust the tax expense to make sure that we're recognizing all the tax consequences when our transaction occurs. Now, when we look to IAS 12 follows what is called a balance sheet approach. Okay, and what does that mean? It means that in terms of calculating deferred tax, we look at the statement of financial position, okay, and we identify all our assets and liabilities, and we would then calculate deferred tax on those assets and liabilities. So how do we go about calculating our deferred tax? Our calculation simply is we take the carrying amount, we compare the carrying amount to the tax base to then give us a temporary difference. That temporary difference is multiplied by the applicable tax rate to then give us our deferred tax. Now let's look at each of these components individually. When we think about our carrying amounts, remember our carrying amounts of our assets and liabilities are sitting on the statement of financial position. Okay, so why do we calculate deferred tax on these assets and liabilities? Well, because when we recover our assets or when we settle our liabilities in the future, they are going to give rise to tax consequences. And so what we want to do now is we want to recognize the fact that in recognizing assets and liabilities, we also need to account for the future tax consequences today. Okay. So now that we understand where we're getting our carrying amount from, let's talk about the tax base. Okay, so the tax base for an asset and for a liability would differ. Okay, for an asset, we've got to think about the future economic benefits. So the future economic benefits can either be taxed or the future economic benefits of an asset can not be taxed. Okay. If the future economic benefits of an asset are taxed, then the tax base becomes the future deductions, okay, that we can deduct from any income that we generate. And if the future economic benefits of the asset are not taxed, then we will use the carrying amount as the tax base. So this is what happens when you try to do deferred tax when you are completely exhausted. I misspoke when I mentioned what the tax base of a liability is. The tax base of a liability is actually the carrying amount less any amounts that will be deductible for tax purposes. So it's not what I've said in the video. I do apologize for that, but I just cannot reshoot this video because it takes so much time. So just pretend that never happened. It happens to the best of us. And yeah, I hope that that you can just watch this and know that even the best of us, we all make mistakes, but we can learn from our mistakes and we can move forward. So keep moving forward, and remember the tax base of liability, carrying amount, less amounts that will be deductible for tax purposes in the future. Now for a liability, our tax base is the carrying amount less any amounts that will not be deducted, okay, in the future. Okay, and if our liability that we're dealing with is income received in advance, then it would be our carrying amount less any revenue, okay, not taxed. So if you are in a situation where you need to calculate deferred tax, remember that for assets, okay, Let's do some highlighting over here. Okay, so remember that for assets and for liabilities, we have a different tax base. Okay, now let's move on and think about our temporary difference. Okay, so when I compare my carrying amount and my tax base, okay, if those two differ, we call that difference a temporary difference. A temporary difference only occurs if the difference between accounting, okay, and tax will unwind over time. Okay, so what does that mean? It means that for now, accounting could be treating something, a transaction, in a particular way. So let's say that for now, accounting is going to allow you to recognize your expense over perhaps 4 years. But from a tax perspective, the taxman is allowing you to take all of your expense as a deduction now. If we were to compare then the carrying amount and the tax base of this either asset or liability, we would see that there's a temporary difference, and that difference is temporary because both from an accounting perspective and from a tax perspective, you're going to be able to recognize the full expense or deduction. Okay, the difference between the two is just your timing. Okay, now if these timing differences or temporary differences, we say, can be either they can be taxable or they can be deductible. Okay, so if my temporary difference is taxable, okay, if it's taxable, it means that in the future, okay, my tax profit is going to be greater than my accounting profit. Okay, so that means that in the future I'm going to pay more tax. Okay, and if my temporary difference is deductible, it means that in the future my tax profit is going to be less than my accounting profit, which means that in the future I'm going to pay less tax. Okay, so when deciding whether our temporary difference is taxable or deductible, we always think about the future tax consequences. Now, getting back to the difference between the accounting treatment and the tax treatment. If there is a difference between accounting and tax, and that difference will never unwind over time, then we would call that a permanent difference. So a permanent difference would be when we can claim the expense from an accounting perspective, but we cannot get a deduction from a tax perspective ever. So we can see in that case there's a difference between accounting and tax, but it is never going to unwind, therefore it is a permanent difference. Okay, permanent differences do not, okay, give rise to deferred tax. Deferred tax is only on temporary differences. Okay, so that's the temporary difference part. Okay, let's see what's the next part. It is our rate. So let's talk about the rate. Okay, must reflect the manner, okay, of recovery. Okay, meaning if we expect to recover our asset through use, we must use a tax rate that reflects usage. So for example, a revenue tax rate. Okay, if we have an asset that we expect to recover through sale, then we need to use a tax rate that reflects the consequences of sale, which could be either a capital gains, okay, tax rate, or it could be a revenue tax rate, and that just depends on the underlying asset. Okay, so we have to use a tax rate that reflects the manner of recovery. The other thing is that our tax rate has to be based on rates that are enacted or substantively enacted at the year end. So what does that mean? Okay, if it is inextricably linked to a change in tax law, then we can only regard it as substantively enacted when it is passed through Parliament. Okay, so that's the key thing that we need to remember over there. Okay, what's next? Okay, we've got to think then about, let's go back over here. It's then calculating our deferred tax. So once we calculate our deferred tax, remember our deferred tax, it can be either a liability or it can be an asset. Okay, for now, we're not going to deal with assets. We're going to talk about assets later, but let's just think about this liability. So this liability is going to appear on the statement of financial position. Okay, where is it going to appear? Okay, in terms of IAS 1, it is a non-current liability. Okay, so we would have a deferred tax balance on the statement of financial position. Okay, now we are going to present it as a non-current liability, but there's also going to be somewhere in the notes, okay, we are going to have to disclose our deferred tax. Now, before we move on to the note disclosure, remember that on the face of the statement of financial position, we could potentially offset our deferred tax asset and our deferred tax liability. Okay, and that really depends. So when we're deciding whether we're going to offset either current taxes and liabilities or current or deferred tax assets and liabilities, we've got to think about whether we have a legally enforceable right to do so. Okay, and whether we intend to settle on a net basis. Okay, there's also considerations around group tax, but we don't have group tax in South Africa, so that's fine. And the other consideration is also that these taxes, before you can offset, it must be levied by the same tax authority. And in the case of South Africa, that would be the South African Revenue Service. So that would be SARS. Okay, so if you have a legally enforceable right and you intend to settle on a net basis, then you can offset your deferred tax asset to your deferred tax liability and just recognize that net deferred tax liability over there. Okay, now we've got, if we think about our financial statements, so let's think about what should be in our note disclosure. Okay, where do we see deferred tax? Okay, we see deferred tax on the statement of financial position. We see deferred tax over there. And on my statement of profit or loss and other comprehensive income, we see our tax expense. Now, our tax expense, remember, it includes both current and deferred tax. Okay, so current and deferred tax. The way we calculate our current tax is that we take our company's profit before tax, we adjust, okay, for the differences between accounting and tax. Then we get our tax profit. We multiply that by the tax rate, and that would give us our current tax. Okay, our deferred tax would be the movement in the balance on the statement of financial position. Okay, so that is where we see deferred tax. So our first disclosure, okay, disclosure number 1, okay, is the statement of financial position disclosure. So on the statement of financial position, we have a balance. Okay, now our balance is made up of temporary differences. So what we need to disclose is we need to disclose which temporary differences make up that balance. That's our first disclosure, okay? It's about taking all the temporary differences that make up the balance and just listing them with the related tax amount. Okay, so that's pretty straightforward. The second disclosure, okay, would be our profit or loss disclosure. So in profit or loss, what do we have? Okay, so in profit or loss, we have our major components. So our major components are our current tax and our deferred tax. So we need to disclose everything that's in current tax and everything that's in deferred tax. Now in current tax, you would have your current year expense. You could have an over or under provision from the prior year. Okay, so all of those would be disclosed under our current tax. For our deferred tax, remember, it is the movement. Okay, but that movement could have come from potentially a change in the rate, or it could have come from the movement in the temporary differences. The idea here is that anything that caused the deferred tax to move, you are going to disclose separately. Okay, then the third disclosure is our recon. Now, our tax rate recon, the idea behind the tax rate recon is that we explain why our expected tax, okay, is not equal to our actual tax. Now, our expected tax, that would be taking our profit before tax multiplied by the tax rate, because that is the tax that we expect to pay. However, our actual tax is what is sitting in the statement of profit or loss. So we have to compare why these two numbers are different. And they could be different because there are perhaps permanent differences. Okay, there could be a change in the tax rate. There could be an over or under provision. Okay, and there could be many other things that would explain why expected and actual tax are different. But the principle with this disclosure is, remember, my starting point versus my end point. Okay, so you've got to think about your starting point. What is your starting point? Your starting point is profit before tax. What is your end point? It is your current tax plus your deferred tax. So if there's something in your starting point that's not in your end point, then that would be a reconciling item. If there's something in your end point that's not in your starting point, that again is a reconciling item. If something's not in your starting point and it's not in your end point, then it is not a reconciling item. And if something is in your starting point and it is in your end point, then again it would be not a reconciling item. Now, there are many other disclosures that we need to know. So for example, we could have the OCI disclosure if we had tax in OCI on the items recognized in OCI, and we would also need to disclose things like additional notes on the change in tax rate and the impact thereof and so forth. But I think these are the key principles that you need to understand in order to be able to correctly present, okay, and disclose deferred tax in the statement of financial position. Okay, I hope that video was useful. If you have any questions, please leave them down in the comments below. Make sure to subscribe for more content, and I'll see you in the next one. Bye bye.